The Nigerian Customs Service has recorded significant growth in its advanced ruling program, with accounts rising from 60 in December 2024 to 173 in December 2025. This was disclosed by the Service National Public Relations Officer, Abdullahi Maiwada, in a statement. Welcome to Business Point, where we x-ray the Nigerian economy and the government policies. I am Kike Lomo Okere. At the 17th session of the Capacity Building Committee of the World Customs Organization in Brussels, the National Public Relations Officer of the Nigerian Customs Service, Abdullahi Maiwada, says the increase represents a 188.3% growth in stakeholders' participation. He noted that a total of 83 advance rulings were issued in 2025, adding that the initiative contributed 2.9% of total custom revenue from goods valued at 240.8 billion naira within the period. The customs spokesman explained that the advanced ruling system provides importers and exporters with binding decision on classification, valuation, and origin of goods prior of shipment, thereby enhancing predictability and compliance. According to him, the service reform communication strategy is anchored on institutional capacity building, human resource development, and stakeholders' engagement to ensure the policies are well understood and effectively implemented. Highlighting findings from the time-release study, Maiwada stated that delay in cargo's clearance are largely due to systemic idle time rather than inspection process, noting that improved data presentation has helped strengthen accountability across the trade value chain. On the Authorized Economic Operators Program, it disclosed that about 120 companies have been granted full clarification, while 3,200 officers have been trained nationwide to support its implementation. Maiwada also referenced the deployment of the Unified Custom Management System, known as Bodogu, as part of ongoing digital transformation efforts within the service. He added that the introduction of the Custom Integrity Perception Survey is enhancing transparency by providing measurable indicators of accountability and public trust. The spokesperson further urged member administration of the World Customs Organization to integrate effective communication strategies into reform initiatives and promote sustained stakeholders' engagement. Nigeria insurance sector has emerged as the fastest growing segment of the financial service industry, recording a strong 21.37% growth in the fourth quarter of 2025. Data released by the National Bureau of Statistics indicates that the performance marks a significant increase from 6.6% recorded in corresponding period of 2024. On an annual basis, the insurance sector recorded a growth rate 16.04% in 2025, reflecting a substantial improvement from 3.42% in 2024. Despite this strong growth, the sector accounts for 9.57% of the finance and insurance industry, indicating potential for further expansion. The banking subsector, which remained the dominant component of the industry, recorded a growth of 7.08% in real terms in the fourth quarter, with an annual growth of 14.36%. Overall, the finance and insurance sector grew by 8.30% in real terms, contributing 2.56% to the nation's gross domestic product, while Nigeria's economy recorded a 4.07% growth in the fourth quarter of 2025. In other sectors, transportation and storage recorded a strong growth of 21.25%, driven by road and air transport activities. The information and communication sector grew by 7.55%, with telecommunication maintaining its position as a key driver of growth. The oil and gas sector sustained its recovery with a growth rate of 6.79%, supported by average daily production of 1.58 million barrels per day. Construction recorded a growth of 5.08%, while manufacturing posted a modest increase of 1.13%. The service sector remained the largest contributors to the economy, accounting for 55.95% of total gross domestic product in the first quarter of 2025. The strong performance of the insurance sector highlights increasing activities and potential within the industry. However, its relatively low contribution compared to banking, which indicates that there is still significant room for growth and wider market penetration. Nigeria's agriculture recorded a strong performance in 2025, with total turnover rising to 101.46 trillion naira, up from 96.46 trillion naira in 2024. Latest data from the National Bureau of Statistics shows that the sector real growth increased to 2.92% from 1.69% recorded in the previous year. The sector's nominal contribution to gross domestic product also rose by 5.18% year-on-year, supported by increased investment and favorable government policies, including importation waiver. Crop production remained the backbone of the sector, contributing about 64.41 trillion naira, followed by livestock at 25.66 trillion naira, forestry at 6.47 trillion naira, and fishing at 4.92 trillion naira. The sector maintained steady momentum in the fourth quarter of 2025, recording a 4.00% growth rate and contributing 27.55% to the nation's GDP. Increased private sector participation, expansion in agro-processing, and renewed investors' confidence are identified as key drivers of the growth. However, concerns are mounting over the impact of the import policies on local production, as increased food imports contributed to price decline in domestic markets, affecting farmers' income. Economic analyst warns that while low food price benefits consumers, sustained reliance on imports could weaken local production and discourage investment in the sector. The growth highlights agriculture's resilience and its central role in the Nigerian economy. However, maintaining this trajectory will require a careful balance between attracting investment and stabilizing prices, and protecting local farmers to ensure long-term food security. Nigeria recorded a trade surplus of $1.28 billion in November 2025, driven by a significant decline in import bills. According to the Central Bank of Nigeria monthly economic report, the surplus represents a 4.1% increase from $1.23 billion recorded in October. The improvement was largely attributed to an 8.07% drop in total imports, which fell to $3.55 billion during the period. Further breakdown shows that non-oil imports declined by 4.28% to $2.46 billion, reflecting reduced demand for capital and consumers' goods. Oil imports also dropped to $0.94 billion from $1.10 billion, supported by lower domestic demand and increased local refining capacity. Despite the improved trade balance, total export earnings declined by 5.22% to $4.83 billion. The drop was driven by weaker earnings from crude oil, gas, and refined petroleum products, which accounted for over 85% of total export. Crude oil export receipts fell due to a decline in global oil price, while earnings from gas and refined products also weakened amid lower international demand. Non-oil exports recorded a further decline of 6.80%, impacted by reduced earnings from food export following increased global supply and lower commodity prices. The trade surplus reflects improving import substitution and reduced dependence on foreign goods. However, declined export earnings, particularly from oil, highlights Nigeria's continued vulnerability to global price fluctuations and the need to strengthen non-oil export for sustainable trade growth. Global oil markets are on high alert as key members of the OPEC and allies, collectively OPEC Plus, announced a sharp increase in production quotas. Against the backdrop of the escalating Middle East tension, the V8 subgroup, including Saudi Arabia, Russia, Kuwait, Oman, Iraq, UAE, Algeria, and Kazakhstan, approved a 206,000 barrel per day output boost set to take effect in April. The decision exceeds analyst forecast of 137,000 barrel per day, signaling a strong response to market pressure amid regional instability. The increase followed US and Israel strike on Iran and Tehran retaliatory missile attack across Gulf states. Iran has reportedly targeted the Strait of Hormuz, the world's most strategic oil choke point, where nearly a quarter of global seaborne oil passes. State media reported a tank struck and ablaze, raising fear of several supply disruptions. Despite OPEC Plus framing the output adjustment as a key response to a steady global economic outlook, analysts warn that geopolitical risk now dwarf production target. Restart Energy notes that 206,000 barrel increase is unlikely to calm market if shipping through Hormuz is disrupted, as logistic and transit risk outweigh incremental supply gain. The situation keeps oil price vulnerable to spikes, with crude, gas, and refined products at the mercy of regional security development rather than OPEC Plus quotas. While OPEC Plus production increase may temporarily ease supply pressure, the real driver of the oil volatility is Middle East geopolitics. Any escalation around the Strait of Hormuz could trigger dramatic price surge, underscoring the global energy markets remain hostage to regional conflicts, not just output policies. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Points on Global Television, where we extract the Nigerian economy and the government policies. Nigeria's building material giant Lafarge Africa PLC has posted a record revenue of 1.1 trillion naira in 2025, up from 53% from 696.8 billion naira in 2024, marking a historic milestone for the company. Profit after tax soared by 173% to 273 billion naira, while operating profits doubled from 193 billion naira to 392 billion naira, driven by volume-led growth, disciplined cost optimization, enhanced plant stability, improved distribution, retail expansion, and efficient financial management. Earnings per share jumped from 6.22 naira to 17 naira, reflecting a remarkable 173% increase, signaling strong shareholders' return. The company's performance underscores the effectiveness of its strategic execution, operational efficiency, and focus on delivering value. Collaboration with industry partner Houghton position Lafarge Africa to capitalize on new opportunities in 2026, while maintaining cost discipline and agile capital allocation. Lafarge Africa results highlight how strategic investment in operational efficiency, distribution, and plant reliability can translate into record revenue and profit. The surge demonstrates resilience in Nigeria's construction sector and positions the companies as a dominant player ready to leverage emerging market opportunity despite economic uncertainties. Nigeria's cement giant Dangote Cement PLC posted a 20.3% revenue growth to 4.31 trillion naira in 2025, up from 3.58 trillion naira in 2024, marking a landmark financial performance. Despite domestic operation led the surge, generating 2.96 trillion naira, up to 34.8% year-on-year, while the Pan-Africa revenue slightly dipped to 1.46 trillion naira due to lower sales in some markets. Total cement sales were 27.47 million tons, marginally down from 27.71 million tons in 2024. But strong pricing and export strategies boosted margin. EBITDA rose 43.4% to 1.98 trillion naira, with EBITDA margin of 46%, up from 38.6%. Operating profit climbed to 1.77 trillion naira. Profit before tax hit 1.53 trillion naira, and net profit surpassed 1.01 trillion naira, more than doubling in 2024, 503 billion naira. Earnings per share jumped to 59.86 naira from 29.74 naira. The company strengthened its balance sheet, reducing the net to 682.9 billion naira from 2.06 trillion naira, while total assets stood at 6.04 trillion naira. Highlights include the commissioning of the 3-metal grinding plant in Côte d'Ivoire and 18.6% increase in cement and clinker exports to Ghana and Cameroon. Dangote Cement results demonstrate the power of margin discipline, cost efficiency, and strategic export. Despite a slight drop in volumes, the company leveraged pricing, operational skills, and regional expansion to cross 1 trillion naira profit milestone, cementing Nigerian leadership in West African cement market. Nigeria's oil sector saw a significant portion of its 2025 revenue tied to crude-backed loan obligation, with estimated 14.66% of the total crude production, that is 77.75 million barrels, committed to servicing 4 major arrangements: Project Gazelle, Project Yield, Project Leopard, and Eagle export funding, based on the 2025 average burning light price of 72.08 barrel and the official exchange rate of 1,492 per dollar. The crude allocated to debt servicing is valued at roughly 8.36 trillion naira. The loan underpin the refinery rehabilitation, advance tax and royalty payments, and other corporate financing needs, highlighting how the sizable chunk of gross oil earning is effectively earmarked before reaching government coffers. Despite producing 530.40 million barrels in 2025, Nigeria missed its OPEC quota, with crude for loan obligation constraining cash flows. Additionally, gas delivery arrangements under the LNG further tie up revenue. Expert warns that opacity of these arrangements, particularly forward sales and swap executed under Pyro administration, limits full visibility of national oil earning, while transparency and professionalism in the NNPC have improved under current management. Analysts call for full disclosure of all crude for cash agreements to restore confidence and strengthen fiscal oversight. The scale of crude tied to loan underscores the delicate balance between rising emergency financing and safeguarding revenue for national priority. With nearly 15% of production pre-committed, the government faces constraint on fiscal flexibility, reinforcing the need for transparent reporting and prudent debt management to protect Nigerian oil-dependent economy. All right, before we call it a wrap, let's take a quick look at the stock market. The Nigerian Exchange Limited ended last week of February in the red, with market indicators reflecting bearish sentiment and declining investors' activities. The NGX All-Share Index fell to 1.11% to 192,826.78 points, while market capitalization declined by 1.40 trillion naira to 123.76 trillion naira. Trading turnover dropped sharply, with 5.494 billion shares worth 196.709 billion naira exchanged in 370,233 deals, down from 7.66 billion shares valued at 252.566 billion naira the previous week. The financial service industry led activities with 3.241 billion shares worth 82.775 billion naira, accounting for about 59% of the total volume. Oil and gas and service sector followed distantly. Top equities traded include Jopal Gold and Ventures, Fortis Global Insurance, and Zenith Bank, which together represented 28.68% of total turnover. Winners included Fortis Global Insurance with plus 56.67%, Okomu Oil Palm with plus 20.92%, and Infinity Trust Mortgage Bank with plus 20.63%. On the downside, Associate Boss Company led decliner with a 25% drop. Regulatory action also marked the week as the NGX suspended trading in Cheesy Agro Allied Industry PLC effective February 23, 2026. Citing investors' protection and pending an investigation into trading activities, the market dip reflects cautious investor sentiment amid high volatility and regulatory scrutiny. While strong gains in select stocks shows pockets of opportunities, the broad decline and the sharp reduction in trading volume signals lingering uncertainty in the equity markets. All right, this is where we call it a wrap on Business Point today. Join me again next time on Global Television, channel 365, on DSTV, and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.